Hello there. Welcome back to Cost and Management Accounting F6. They want to look at a question paper from November 2023. This is question 5. So we're going to look at question 5, which is on the calculation of break-even point. And the question reads, the following information was extracted from the records of SASTO at the end of financial year 30 April 2020. And we are given a table where we have sales, variable costs, total costs, and units produced. Then on the first part of the question is saying calculate the following. On 5.1.1 saying break-even units. So we need to calculate the break-even points in terms of units. So we are going to put the formula down, and then we calculate the break-even in units. So what we have, this is 5.1.1, and we know that on the calculation of break-even break-even points in units, we are going to say break-even points in units, it is equal to, let's try to see the formula. We say we are going to say the numerator is going to be fixed cost, going to be the fixed costs, and on the denominator we are going to calculate it as our selling price per unit. This is selling price per unit, and then we multiply, you subtract the variable costs per unit. So this is the formula that we are going to employ. So according to the question that we are given, we are seeing that our fixed costs, we are given our fixed costs there. We don't have our fixed costs there, which means we have to find our fixed costs. Remember, to find our fixed costs, we are going to say, remember, we have a formula which says our variable costs plus our fixed costs is equal to total cost. So we are given our total cost here is 450,000. 450,000, and then our fixed cost is the figure that we are looking for, and then our variable cost we are given 200,000. So we can just make fixed cost start with the formula there. So when you make fixed cost start with the formula, obviously it's now going to be fixed costs are equal to 450,000, and then we subtract the 200,000. If you take 200,000 the other side, it becomes a negative and becomes 200,000. So if you calculate as it is, you are going to see that you are going to get 250,000 as your fixed cost. So we are just going to put our fixed cost there as our numerator. So if we come here, you are going to see that we are now going to say 250,000 is our fixed cost divided by our sale price per unit. We come here, you'd see that our sale, we are given sales in total. So what we are going to do, we are going to say sales in total get sale price per unit divided by the number of units produced, which is 5,000. So if you divide the two, you're going to see that you're going to find 140 rands per unit. So this is the selling price per unit. And obviously, we need also the variable cost per unit. So variable cost per unit now, this is now the variable cost per unit. We are going to say the total variable cost that we have is 200,000, and then we divide by 5,000. Get the variable cost per unit. So if you divide there, you are going to see that you're going to get 40 rand per unit. So we now know that our selling price per unit is 140. Our variable cost per unit is 40 rand per unit. So this is the figures that we are going to use here. So 140 minus 40. So here you are saying is the denominator, selling price minus variable cost per unit, 140 minus 40. And then if you divide this, you'd see that here we are going to say 250. 250,000, you subtract 240 minus 4 to get 100. So it's going to be 250,000, and then you divide by 100. So let's try to calculate that. You're going to see that if you divide this, you're going to get 2,500. So 2,500 units is the break-even point in units. So this is what we have. The break-even point in units is 2,500 units is break-even point in units. So this is what we have there. So on the first part, break-even points and units 2,500. So you go to the next question to see what we have there. So if you go to the next question, now needs us to calculate break-even value. So we need to put the formula down first. If we have found break-even point in units, it's very simple to pick now to get the break-even value. We are now saying the break-even in units terms and the sales the selling price per unit. So on the second part, which is 5.1.2, we are going to say we are now on 5.1.3. So on 5.1.2, we are now saying break-even point is a value. Formula that we can use there is break-even point. It's equal to break-even point in units. Then we multiply by the selling price per unit. Selling price per simple as that. So break-even point in units. Remember, that's the figure that we got there. So we're just going to say break-even point in units is 2,500 units that we got here. And then we multiply by the selling price per unit. The selling price per unit that we got here, it's 140. It's 140 per unit. So we are just going to substitute that as we have that. So if you do that, you see that if you calculate there, you're now saying 2,500. Then you multiply by 140 units. Get the you multiply by 140, which is 140 as the selling price per unit. So this 2,500 is units, and then this one is selling price per unit. So this one is once. So if you calculate to get the value now, 2,500, if then you multiply by 140, you're going to get 350,000 rands. So this is what we have in terms of break-even points in value. Then we go to the next question to see what to behave in terms of the next question. So if you come here, see we got next one is saying safety margin in the rands. Safety margin rands. So what we need to do is also to put down the formula of the safety margin in rands. So let's try to see what we have. Come here. Let's try to put that one down. So you see that the safety margin is now on 5.1.3. And we are saying safety margin in rands. So basically, this one, we are just saying we are calculating it in the form of value. So safety margin is the gap that we have above break-even points. So basically, it's between the break-even point and the maximum production. So when it's in value, we are now saying the selling value. Sales, let's just say the sales, which is the value. Then we subtract the break-even point in value. Break-even point in value. Then we get our safety margin in rands, which is a value. Right? If it's the safety margin in number of units, we are just going to say the production level minus the break-even point in units. If you want to find the safety margin in units now. So here we are just going to check the figures that we have for sales and then the break-even point in value. So if you come here, you see that the sales figure is 700,000, and then the break-even point in value, we calculated it, it was 350. So we subtract the two. Here, the break-even point in value is 350,000. So we are just going to subtract the two. So if you come here now, we're now saying the sales value that we are given, we're given 700,000. 700,000, then we now subtract the break-even point in value, which is 350,000. Right. So if you do that, now we go subtract the two, we are going to get 350,000 rands. So this is the safety margin in rands. So that is what we have. Then we go and check the next question, what we have in terms of the next question. So if you come here, see that we are now with 5.1.4. 5.1.4 is prove that the business actually does break even by referring to the break even units calculated in question 5.1.1. So we want to see if the business is breaking even. So remember, at the break even point, that's where we got a profit of zero. So basically, what we are saying is at the break even point, we are saying sales minus total cost should be equal to zero. So this is what we want to prove. So we go at the break even point and find this the sales value at break even point. Remember, we got 2,500 units at break even point. So you multiply by the selling price per unit to get the sales at break even point. And then the total cost, we are going to say variable cost at break even point plus fixed cost at break even point. And then I'll get the total cost. Then I'll subtract it from the sales to get the figure that you're supposed to get is supposed to be same. But basically, the fixed cost is not going to change. Remember, fixed cost will not change level of output. Even if you produce 0 units, fixed cost will be the same. Produce 100 units, produce any number of units, but fixed cost remains the same. So we've got a constant figure in terms of fixed cost. So sales, remember the sales that we have at break-even point, we are just going to check at break-even point we have 2,500 units. We go back to our calculation to start break-even point in units is 2,500. Then we multiply by the selling price per unit. Selling price per unit, we calculated it here. It will go to 140 per unit. So we're going to say break-even point in units times sales. And then we get the sales value at break-even point. Then we say for the total cost, we're going to say fixed cost. We're just going to take the figure for fixed cost, which is this one that we calculated is 250,000 plus for variable cost per unit. We are going to get the total variable cost. We are going to say first define the variable cost per unit by saying 200,000 divided by 5. So if you say 200,000 divided by 5, you get the variable cost per unit. So we say 200,000, then you divide by 5,000 units. Then you divide the two there. You're going to see that you're going to get your 40. You're going to get your 40, 200 and divided by 5,000, 200,000 divided by 5,000, you are going to get your 40. So our 40 runs per unit. So yes, means we've got 40 runs per unit is our variable cost per unit. Then we multiply the number of units and variable cost 2,500 to get the variable value at break-even point. Then so here what we are going to do, just say we're going to say this is now the representation now calculating the profit at break-even point, which is supposed to be 0. This is what we want to prove. So here we are saying sales. So sales at break-even point, we are saying at the break-even point we have 2,500 units. Then we multiply by selling price per unit, which is 140, like this. And obviously we calculate how we multiply the two. Answer that we are supposed to get is supposed to be 350,000. And then we are going to less total cost. Less total cost. The total cost we are saying is variable cost plus fixed cost. Remember fixed cost. We are saying it doesn't change with the level of output. So we are just taking the fixed cost that we have in the question. It applies at every level of output. Fixed cost that we have there, we calculated the year and it was 250,000. So we're going to say 250,000 for our fixed cost. Then our variable cost. Our variable cost, remember, we calculate it, we got 40 rand per unit. Here's our variable cost per unit. Then we multiply by the number of units at the break-even point, which is 2,500. So if you multiply that by that, you get 100,000. So you get 100,000 here. Then we are supposed to add the two so that we get the total cost. So if you add 250 plus 100,000, you're going to get 350. So you see now the total cost is equal to sales value. So if say 350 minus 350,000, you get your profit here as zero. So this is now the net profit. So net profit should be zero at break-even point. That is saying that is our break-even point. So basically, we've proven that this is the break-even point at 2,500 units. So this is what we have. Let me check on the next question. Let's check, see what we gave in terms of the next question. So if you come here, you see that 5.2 is the next question saying the following information was extracted from the records of junior producers at the end of the financial year 31 May 2020. We are given a list of balance that we are having there, and then the question is prepare the income statement according to the direct costing method. So we need to know when we are using the direct costing method, what are we supposed to do? So in terms of the direct methods, we are first supposed to say sales minus our variable cost. So when you subtract that, we are supposed to get marginal income. Then after finding your marginal income, remember for total cost we say fixed plus variable. So we are also supposed to subtract the fixed cost. So later on now we say marginal income subtract fixed cost. Then you get your net profit. This is exactly what we are supposed to do when we are presenting in terms of the direct costing method. So basically, we come there on our answer section. So what we are supposed to do, supposed to first start with the figure for sales. First, supposed to start with the figure for sales. This statement is the income statement. Income statements are using the direct costing method. So we are starting with sales. Remember, our sales we are given in the question. We go and check the value of sales. So you see that sales here we've got 450,000. So we're just picking 450,000. So we are saying 450,000 here. 450,000. 450,000. Then we go and check in terms of the next one. We are saying less variable cost. So we are just going to say less variable cost. But our variable costs, we have components of variable cost that we have in the question. So if you come here, you see that we have variable manufacturing overheads, which is variable manufacturing overheads. We have 20,000. And then we also have variable selling and distribution, 2,000, part of variable cost. And then also we've got direct labor, 100,000, the variable cost again. Then direct material, we've got 80,000, so a variable cost. So we're going to add all of this, then we get the total variable cost. So we can just go and list those. So we are saying for variable cost, we've got direct material, cost that the value that we have for the material is 80,000. Let's check there. Direct material is here 80,000. Then we have also direct labor and saying 80,000. Direct labor. From direct labor, we have 100,000. Right. And then we also have variable selling and administration. Variable selling and administration. Come here, you see that all the variable selling administration give 2,000. So it's in 2,000. And also we have variable manufacturing overheads. So when the variable manufacturing overheads, we check again, value. We have here we put 30,000. So we put in our variable manufacturing overheads is recheck in terms of value. Variable manufacturing overheads, we put 20,000, sorry, here 20,000. Going to put our 10,000 there. We're saying 20,000. And then obviously now we get the total. Get the total for variable cost, total variable cost, and then you put it here. Get 8,000 plus 100,000 plus 2,000 plus 20,000. We're going to get 202,000. Obviously now we are saying less. Remember we're saying less, we subtract, so it means here subtract. And we subtract there. You see that if we subtract there 450 minus 202,000, we're going to get here 248,000. And this figure that we are getting is now the marginal income. And for the marginal income now, we are now supposed to subtract fixed now. Values were fixed, so we are saying, let's try to see. We are saying now let's fix cost here. So fixed costs, we will put the total here, then we list the fixed cost that we have in the person, we go back to check what we have. In terms of fixed costs, we have got fixed manufacturing overheads 8,000, and also we have got fixed selling and distribution cost 3,000. So we can just go and list those ones. So we are saying fixed manufacturing overheads. Fixed manufacturing overheads, and the amount that we have, is 30,000. Then we have our fixed selling and administration. Figure that we have 3,000. Obviously, we are going to close. Then we add the 2 to get 53,000. Now, remember we are saying less here, so we are subtracting. So we subtract the 2 to get now the net profit. So if you multiply 248,000 plus 33,000, you get 450,000. So this is going to be your net profit. So we are saying here net profit. So this is the end of our question. Hopefully this video was helpful. Those who haven't subscribed, please subscribe and share. It's still coming more videos. As for this video, signing out.